Hello everyone. I'm very happy to announce that we have reached 500 subscribers. On this special occasion, I wanted to do a dedicated learning video on short straddle. That was my commitment, which I promised to the community members, and I will honor it through this series. So, in this series, we are going to explore a very crucial, critical, and most widely practiced strategies all across the world in every index, in every option stock, whether it is stock options, whether it is F&O. This is one strategy that's been extensively used by investors of all capabilities and capacities. uh, the strategy that we are going to discuss in this series is short straddle, and this short straddle series is extremely critical because you can use it for various purposes. You can use it positionally, you can use it for swing trade, you can also use it for intraday trading. So, without further ado, let's dive into the basic objectives of the series. First, we will be looking at what is a short straddle, and then what are the considerations one should have in order to initiate a short straddle. Short straddle can be initiated almost in every market, provided you know what you are doing with your short straddles. And there are various ways to initiate short straddle that we will cover in the next video. But in this first part, what we are going to cover is the basic introduction to short straddle and how it works in the long run, right? And we will also take some time to investigate why big money is, very much fond of this particular strategy. Lot of, big players deploy this strategy even for intraday, trading. They use this strategy extensively. And why is it so? That's something we will cover. And at the same time, we will also try to understand when to initiate a short straddle, how do we initiate it, and everybody talks about adjustments. So why to adjust and when to adjust is something we will cover. And what are the potential risks associated with short straddles and how do we mitigate this risk, and what should be the basic discipline that one should have while having a short straddle initiated. And with that, I will also be sharing some practical guidelines and some general things to keep in mind in order to improvise and optimize your profitability using short straddles. So that will be the broader sense of what we are going to cover in this series. Let's dive in and understand what is a short straddle. So a short straddle is, if you look at it, there are two words. One, short. Short means selling of options. Like you can buy an option or you can sell an option. Short is the word for selling of options. Long is used to denote that we are buying options, right? So short means selling of options. Straddle means, you look at this, there are two D's in straddle, right? D and D, which means we are going to sell the same strike. So when I say same strike, it doesn't mean that necessarily we go to sell where the market is trading right now. For example, if it is at 44,800 as of no, 6th August, doesn't mean that we should sell only 6th of August. I mean, only that 800 call and put. You can sell 45K call and put. You can sell 44K call and put. You can choose to sell any strike, but the strike has to be same. This strike that you're selling has to be same on the calls as well as the puts. That's what a straddle is, right? So straddle means selling options of same strike. Short straddle is just that. Okay. Long straddle means you may be buying the same strikes, but on the buying side. So straddle involves same strike. That's principally it. And the payoff looks like this. You can see that the payoff looks like this. There is till certain levels you have coverage, and the juncture at which you initiate the straddle will be the point where you make most of the money. Anyway, this is just an example. I will open up Opstra to show you a live example. So we are here in Opstra. Let's go to Builder. Let's choose Bank Nifty. And then you can see that the Bank Nifty spot over here, 44,800, 858. Let's round it off to say 44,900. Okay, just to make things simpler. 44,900 is where we are going to initiate a short straddle. And how do we do that? You see there is a non-directional strategies mentioned over here, right? So when you click that, it will show off all the strategies that's available. Here you see the short straddle. I'm going to click this. It's asking me to choose the strike. Now I'm going to choose 44,900. Let's say August 31st. Let it be a monthly contract. It's easy for us to, this is one thing. As you start learning writings, please always go for longer expiries because the adjustments will be very difficult for people who are starting of their option selling journey for the very first time. You have to work a lot in terms of learning the adjustments and so on. For that reasons, let's through the series we will stick to only month-end contracts just to give you a stress-free approach to option selling. And let's see how 44,900 CE and PE getting sold. Let's say one lot. How does it look like? Let's go and explore that. As you see, this is how the payoff graph looks like. Right now, let's go and explore each of these elements that's listed here, and that will be the part one. This video will come to an end by understanding all of the things that's mentioned over here. All right. So first, let's see. This is the strikes that we have sold. The price is 599 and 497. So when you add this one, almost like 1100 points of coverage we have. Meaning, from here, if the market, this is where 44,858, right? From here, if the market moves 1100 points till the date of expiry, if it is moving only till like 1100 points up, we are still not losing money. On the downside, again, we have a coverage of about 1100 points. The whole basis of initiating a short straddle is to get this long, wide coverage in terms of market suddenly moving here and there. Will not attract much of an loss, but still, if it goes beyond a point, then obviously you will start losing money. For example, if there is any sort of black swan event and then suddenly market opens here, then you stand to lose pretty much bigger, right? So this is something that we should keep in mind. The probability of profitability is 55%, which is definitely good. In fact, in reality, it is always more than what it says, because as an option seller, your chances of winning is much higher than what the probability of profit suggests. Okay. Then what is the maximum profit that you can earn by selling this one lot? 16,444. Now, what is the maximum loss? It's undefined because you may lose unlimited amount of money provided you don't do anything and the market has gone into some sort of crash mode or some big news and big events. Suddenly market rallied like say 2000 points or it fell down like 3000 points. You are in for a trouble, right? But how many times does it happen? Does it happen quite often? No, not really. So this is one of the reasons why this is one of the most preferred choice for big players to initiate a short straddle, right? Then break even is clearly mentioned over here. So about 1000 points on the downside and 1000 points on the upside. Until there, you have coverage. So you don't have to worry. Even if the market moves suddenly, after you initiated here, suddenly it moves here. How much money you are losing on the day that you initiated, 329 rupees. Supposedly it moved, say, like 700 points down, you are losing only 1,800 rupees. For example, if it has moved, say, another 700 points on the upside, 2,300 rupees you are losing. So even on the day that you initiate, if the market moves but not too much, then you stand to lose very little. That's okay. That's within the acceptable range. And there are ways to adjust it, which we will cover separately. But as of now, the reason why anybody would go for a short straddle is to get this sort of long coverage, and as time progresses, you will be able to make more money. So there are certain assumptions. Um, let's say let's understand each component over here. Supposedly on this, so this is zero, the day zero you have initiated. Suppose market has moved one day. What is that you are earning on the first day? If the market on Monday, if the market opens exactly here, you are earning 456 rupees, and immediately you are in profits till the levels of 44,475 on the lower side. Sorry, 44,458 and 45,115. Till there, you are in no loss, no gain. Right? So these are the extremes. Now, day two passes. So second day the market, you are getting more leverage now. Now 44,368 and 45,215. That is the range you are getting. Right? Now let's say that 5 days or 5 days later, what's the scene? We are having coverage of about 44,184 and 45,429. And if the market continues to stay here, you are already gaining 1,851 rupees for selling options of call and put of the same strike, right? Now, let's say 15 days passed, you are getting a wider coverage of about 43,868 to 45,843. And if the market is anywhere in between, you are making some good money. You can see here that you are already making, if the market is staying at 44,800, you're making about 6,000 rupees already, right? That's pretty good returns, right? And typically you look at what is the kind of market movements that's happening in the recent times, how much the market has moved on a given day, in on a weekly basis, how many points it has moved. It will all help you understand that what is the probability of market to stay within this range, and in that sense, how much profit that you wanted to take can also be determined to a larger extent. For example, if the market is, should we have to wait for the expiry to happen? Not necessarily. Say that on 18th day, you are seeing that the market has, you are standing at a profit of about, say, 7,800 rupees. And suddenly you feel that there is some sort of news coming up, or maybe market is trading close to some sort of, resistance zones or, support zones. And you think that there is going to be some sort of directional play, and it might just move too fast from this zone, and probably it might rally on the upside or go down. Some news is about to come, you fear that this is going to enter into some sort of loss. You can choose to close around uh, no, 18th day, 15th day, whenever you feel that you wanted to end it, you can end this and then probably choose another short straddle of directional basis. We can always do such things. We will cover all those things in the next videos, but mainly what we are focusing over here is the how the payoff graph gets changed with time passing, right? How you are entering into more and more profits with each day is being passed. Uh, so this is a credit strategy where you are selling the options and then you have received the premium. That's very nice because you are having the cash from the market instead of you paying to the market, right? So this is a credit strategy, very nice one. The estimated margin is about only 98,000. Pretty simple. Now we have seen the payoff graph. So what is this IB percentage, right? That's something you need to understand. IB is that the implied volatility. Sometimes the market, suddenly moves. The IB can go up. And what if the IB increases by say 5%? Then you are in a you know kind of challenging place because if the implied volatility increases, the uh, prices fluctuations will be very high. And if the price fluctuations are too high and then, it moves, say for example, when the IV is on zero, like same as where it is, on the day of expiry, what is that you are at 46K, let's say, let's go to 46K approximately, yeah. We are losing about 41 rupees on the day of expiry. What happens if the IV increases on the day of expiry? Like 40, you are losing 206 rupees. So originally you were losing only 40 rupees, now you are losing 200 rupees because that is because of the increase in the IV. So as much as the IV changes, the probability of, the profitability will change proportionately, but not too much. But yes, there will be some sort of variation in your profitability, right? So this much is enough around this. So spot as it moves, you know what will happen. Let's say that on the fifth day or sixth day, uh, that the spot from 852, the market has moved like, the market has moved like say 1.5 percentage. You're on the extremes. Still, you are in a profit of about 150 rupees. Yeah, and yeah, 100 and 200 rupees you are in a profit of 250 rupees. So this is only to keep track of things. Suppose you are expecting some sort of news, how it would play out. You know that the market is likely to move about 1% or 0.5%. You can do all your calculations with this tool and then get a picture of how your payoff graph would look like. Okay, I don't want to dwell too much into this. This is pretty simple. Anybody can, just drag this and then, learn how the payoff would look like. Just play with it. There are certain important things that you should, however, learn. That is, what is the positional delta? See, if this is the position that you are carrying till the expiry, what is that delta, positional delta? What is the positional delta? For every rupee move in the index, the spot, the bank nifty moves by 1 rupee. What is that you are losing? You are losing 7 rupees. So whether it moves up, down, doesn't matter. You're losing 7 rupees, right? So this is a good strategy only if the market stays in one place, and if it is moving, you're going to lose money. But you may be wondering, why should I initiate a position like this? If market moves, I am losing money, then why should I do this? Right? Very simple. The reason why you do this is not for the delta. If it is a delta strategy, then it is always a buying only that you can do. When you buy options, the movement is your profit. In selling options, the movement is an enemy for you, right? The more the market moves, the more is a problem for the seller. Doesn't matter whether it is moving on the upside or downside. Any movement is always going to be a trigger for sellers. So still, why people go on to short straddle? It's because of the theta. Okay, delta is the rate of change of price in the spot, but theta is whatever it is. It moves or it doesn't move on a given day. The time value of that option is going down, and how much it is going down? 2,000 rupees a day. It is getting eroded. That is what we are playing for. So an option writer always plays for the theta, not for the delta. Okay. So what is gamma? Gamma is the rate of change of price, how fast the price is. See, price change is good, but how fast it is changing is called gamma. And typically, if you look at the options that's expiring, is going to expire soon, will have higher gamma. This expiry is 31st, which is like 25 days away, and we got a lot of time. So the gamma will be too little, almost insignificant. But if the same position is getting created for this big expiry, let's say on 10th of August, then oh, sorry about that. So on 10th of August, then it's going to be a lot more challenging. Why? The gamma effect will be super fast because the any price movements will show enormous volatility and swing in the option prices. So uh, gamma is high for options that's expiring soon and low for options that's expiring far away, right? And Vega is that what is the rate of change of price with respect to implied volatility? What is the implied volatility changes and 1% change in the implied volatility? How does it impact your uh, options price? So that was like if there is a any sudden movement of 1%, 2%, then this much of additional money that you will be losing on top of what you are losing in the positional delta, right? So this is all the Greeks, option Greeks. Okay. So this is how it looks like. You can also go to this Greeks section of it. Look at the IV positional Greeks we are discussing over here. IV is the implied volatility of this strike and this strike. Both are almost like 11.6, 11.6, which is very good. If there is any sort of considerable difference between the IVs, then it's going to be one-sided trade. For example, if call side is like 13 and this side is like say 10, then if the market moves up, the calls will be giving you more loss than the puts because you are a writer. But if you're a buyer, higher IV value means higher returns. You can higher price movements. But here it is kept almost equal because we are playing non-directional. So it is IV. IVs are better if they are almost same. Right? And the delta value is we are sorry in net to net we are losing about 7 points in this, right? And theta value is the net gain if the option expires at the same price as of today, right? And gamma and vega we have discussed. So these are the things that one should keep in mind. And to put it simply, why we go for short straddle, we will discuss in detail. You are keeping a view that the market will not move so much. It will move, but it will not move beyond a point. You have a lower band and an upper band clearly defined, and you expect the market to stay within that limit. It's time to go for short straddle. And what are the other considerations that one should have? Um, I will make a separate video on that. That will be the part two. We will go and explore how do we arrive at the levels and what sort of strikes should we choose for initiating short straddle and many more things that we will learn in the part two. I hope this was a good basic introduction to uh, short straddle. Looking forward to meet you all in video number 2, short straddle. Thanks.